Hello friends, welcome to Veranda Excel. We will now start today with the budget amendments that are applicable for November examination. Now the coming November examination, whatever is the budget that we have got, that would be what we are going to discuss. Now friends, in this case we will start with one of the very important amendments that was brought in by Finance Act 2020, which is on relating to dividends. A very important amendment that was brought into, which said the erstwhile dividend distribution tax that we had for domestic company, which is section 115O, and certain companies and mutual funds, predominantly mutual funds, section 115R has been abolished. That means till last year it was all, that is when the dividends were distributed, the domestic company should pay a tax. We usually refer to as dividend distribution tax. And once the dividend distribution tax is paid by the domestic company or by the mutual funds, in the hands of the shareholder or in the hands of the unit holder, the income is exempt. What income? Dividend income. Now this entire dividend distribution tax has been abolished. Because the dividend distribution tax are abolished, we will now see what is the consequential amendments that has been brought into the other provisions of the Income Tax Act. In relation to this, what are the consequential amendments that has been brought into? The first and the foremost thing is the exemption under section 1034 and 1035 has been withdrawn. That means if the domestic company or mutual funds are going to pay to the shareholders or to the unit holders, the shareholders or the unit holders will now be liable to pay tax. They would be liable to pay tax. That means dividends are now taxable in the hands of shareholders or in the hands of unit holders. Earlier it was exempt, now it will be taxable in the hands of the shareholders or unit holders. The second thing that we need to understand is, earlier dividends were exempt. Because the dividends were exempt, in the hands of the shareholder or the unit holder, as the case may be, no expenditure was allowed. Please understand, this was earlier. Now the provision is different. Now dividend is taxable in the hands of the shareholder. Therefore, you have to understand that section 57 has been amended to allow expenditure on the dividends. What is the expenditure? Only one expenditure that can be claimed against the dividends, which is interest. No deduction shall be allowed from dividend income other than interest. Interest alone can be claimed. This interest also can be only to the extent of 20% of dividend. That means I have earned, let's say, 10 lakhs. I have earned 10 lakhs as my dividend from the domestic company or from mutual funds as the shareholder. Earlier this 10 lakhs was completely exempt. Today it is taxable, and because it is taxable you can claim expenditure. The expenditure that can be claimed is only interest. The expenditure that you can claim is only interest, which is also maximum of 2 lakhs. Why 2 lakhs? 20% of 10 lakhs will be 2 lakhs. That's the maximum that can be claimed. Now going to the next. Now earlier dividends were all taxable in the hands of domestic company. Therefore in the hands of the shareholder it was exempt because there was a dividend distribution tax. Today you don't have that concept. Therefore when the domestic company is making a payment to the shareholder, the domestic company shall be liable for TDS. That is the next amendment that has been brought into. All are in relation to dividends only. We should understand that, friends. So the TDS on dividend is section 194. TDS on dividend is now applicable, which is given in section 194. Who should be deducting? When the domestic company is making a payment to resident shareholders. When the domestic company is making a payment to resident shareholders. If the domestic company is making a payment to non-resident shareholders, then what would happen? As usual, section 195 would be applicable. Section 195. For most of the payments to the non-residents, 195 would be applicable. Now, here also it will be only 195. Now, the rate of TDS is 10%. Rate of TDS is 10%, and we all know that last year there was COVID. Because of COVID, 95% of the TDS rate has been reduced to 3/4. Here also, if the dividend is paid between 14th May 2020 to 31st March 2021, between 14th May to 31st of March, the rate is 7.5%. Same manner, most of the cases there was amendments. If at all it was 194C, instead of 2% it was only 1.5%. Let's say it was 194H commission, instead of 5% it is only 3.75%. Most of the cases, this is by way of section 197B. Section 197B said in many cases of TDS, it was all reduced from normal rate to 3/4 of that rate. So the dividend, if it is distributed from 1st April to 13th of May, it would be 10%. If it is from 14th May to 31st of March, then it will be 7.5%. When tax has to be deducted, who has to deduct? Domestic company has to deduct while making the payment to resident shareholders. When at the time of making the payment or before distribution of dividend, section 222. 222 is a vast dividend. 222A to 222E, there are 5 clauses. Any clause that you have got, 222A to 222E, dividend tax has to be deducted at the rate of 10%. Now, there are 2 cases where no TDS, that is section 194 is not applicable. 2 scenarios where section 194 is not applicable. First is when a domestic company is making a payment to insurance company. Domestic company, dividend payable to any insurance company. Second, domestic company is making a payment to individual. Domestic company is making a payment to individual and the value does not exceed 5,000. Value does not exceed 5,000. So dividend is payable to individual if paid by account paycheck. Today everything is like account paycheck or directly it comes to your bank account. Very rarely, dividends are paid in cash. And the aggregate amount of dividend, does not exceed 5,000. It should be less than 5,000. Then in that case, there will not be any TDS. 2 scenarios again to quickly summarize. One is if the domestic company is making a payment to insurance company. The second one is in a case where it is paid to individual and the amount does not exceed 5,000 rupees. Now, we were seeing dividends distributed by domestic company and by mutual funds. There were dividend distribution tax, both has been abolished. 194 is applicable only if it is to a resident shareholder by a domestic company. If it is by a mutual fund, then new section got introduced, section 194K. Section 194K. So, to quickly summarize this, if a domestic company is paying dividends to any resident shareholders, in the hands of the resident shareholder it would be taxable. Therefore, section 194 would be applicable. If a mutual fund is making a payment again to a resident unit holder, it will be taxable in the hands of unit holder. Therefore, a new section got introduced, which is section 194K. Now, so it is income from units of mutual funds and UTI. Income from mutual funds of unit funds and mutual funds and UTI. Again, payee. Payee means here recipient. Recipient is resident. Same manner again 10%. As we discussed in the earlier section, the rate again here has been reduced from 10 to 7.5% during that specified period, that is from 14th May 2020 to 31st of March 2021 because of COVID-19 pandemic, to make more funds available for the recipient. The recipient needs more funds. Therefore, most of the cases they have reduced the TDS rate. Now, if at all we carefully understand, it says income from mutual funds. It doesn't say dividend from mutual funds, it says income from mutual funds. From mutual funds, I can have dividends and I can also have capital gains. Earlier, if you go back to section 194, it very clearly says on the dividends paid. Very clearly says it's on the dividends paid. Here it says income from mutual funds. Does it mean that even capital gains would be liable for 194K? That means even if at all we earn capital gains from sale of mutual funds, whether the mutual fund is liable to deduct tax at the rate of 10% under section 194K? No. Now let's see, it says no TDS if the income is in the nature of capital gains. That means at the time of sale of mutual fund units, there is no requirement to deduct taxes. So in other words, what does it mean? Section 194K otherwise would be applicable for dividends from mutual funds. So one more case, TDS would not be applicable if the payment does not exceed 5,000. So quickly, 194K would be applicable for the income from mutual funds or UTI if the tax and the tax rate is 10%, which has been reduced to 7.5% between the specified period. The time of taxes, the time at which tax has to be deducted is at the time of credit or payment, whichever is earlier. The usual thing that we see at the time of credit or payment, whichever is earlier. Like most of the sections has got this 194C, 194H, 194J, I to name a few. Same manner here also. Tax has to be deducted at the time of payment or credit, whichever is earlier. Now moving on to the next amendment that you have got. This is the chapter 6A deduction that is given to a domestic company. New section got introduced, section 80M. New section got introduced, section 80M, chapter 6A deduction. Now, when it is applicable? It is applicable when domestic company receives dividend from any other domestic company or a foreign company or business trust. So what happens? Domestic company receives dividend and it also pays dividend. Domestic company receives dividend and it also pays dividend. Dividend is paid by the domestic company to its shareholders. So what is the deduction? Deduction would be whatever is the dividend received. Whatever is the dividend received, that would be allowed as deduction. However, let's say 10 lakh is received by the domestic company. 10 lakh is received by the domestic company and only 8 lakh is paid to its shareholders. The domestic company has paid only 8 lakhs. Now the deduction would be only 8 lakhs. In other words, the deduction means under section 80M of course, shall not exceed the dividend distributed. Shall not exceed the dividend distributed. So in a very simple language, if at all I have to talk in layman's language, it would be the dividends received or dividends paid, whichever is lower. In a very simple nutshell, if at all I have to say, dividend received or dividends paid, whichever is lower, that would be allowed as deduction. Let's say dividend received is 6 lakhs, dividend paid is 8 lakhs. What would be allowed as deduction? Dividend received is allowed as deduction. However, you have to be a little bit careful here. The dividend paid can be before the due date of filing the return of income. can be before the due date of filing the return of income. Let me take a very quick example so that we all appreciate what is that we are going to discuss here. We will take a very quick example. Let's say 2020-21 dividend received, that is from 1st April to 31st of March, 1st April 2020 to 31st of March 2021. The dividend received is, let's say, 10 lakhs. Dividend received is 10 lakhs. During the same period, that is 2020 to 2021, the dividend paid is, let's say, 4 lakhs. So immediately what we will do, 10 lakhs or 4 lakhs, this is dividend received. If at all I have to be making more, if at all I have to give more clarity, and this is dividends paid. Now it is 10 lakhs or 4 lakhs, whichever is lower, we will say 4 lakhs. No, we should not do like this. The dividends paid is not within that year alone, it is before the due date of filing the return of income. Assuming for a moment, on 31st of March 2021, on 31st of March 2020, 31st of May 2021, another 3 lakhs has been paid. Another 3 lakhs has been paid. Before the due date, yes, what is the due date? Usually the due date would be next year, that is in the assessment year, 31st of October 2021, or sometimes it will be 30th November 2021. We are not going to section 139 where there are amendments again. We will discuss that a little bit later. So here it is 4 lakhs plus 3 lakhs. Totally we have got 7 lakhs. So it would be, you have to take that 7 lakhs, compare with the 10 lakhs, whichever is lower. What is 7 lakhs? Dividends paid. Dividends paid during the year plus before the due date of filing the return of income. So it is 7 lakhs or 10 lakhs, whichever is lower, 7 lakh would be allowed as deduction. 7 lakhs would be allowed as deduction. So quickly, this is a new provision that has been brought into. Dividends received would be allowed as deduction for a domestic company. However, it cannot exceed the amount of dividends distributed. The dividend distributed during the year and before the due date of filing the return of income. That means this 3 lakhs in our given example is distributed in which year? It is distributed in the year 2021-22. It is distributed in the year 2021-22. Why? This is distributed on 31st May 2021. Therefore, it is distributed in the year 2021-22. Now, let's understand the deductions that would be available for the next year. Let's quickly take up to understand the deductions available for the next year. Now, let's say in the year 2021-22, this domestic company has earned another 10 lakhs as dividend. Now, on 31st May 2021, we have paid 3 lakhs. Can you claim this as deduction? No, not possible. This was already allowed in the earlier year. Why it was allowed in the earlier year? Because it was paid before the due date of filing the return of income. Therefore, it was allowed in 2021 itself. That is the next point. Where deduction has been allowed for 1 year, no deduction shall be allowed in respect of such amount for any other year. It is already allowed in 2021. Why? Because it was paid before the due date. Therefore, in the year 21-22, this 3 lakhs again you cannot claim. Very simple. Double deduction not allowed. Double deduction. I pay. I cannot claim 2 times. That is the moral of the story. So, quickly summarizing this ATM, because it is little bit new and my gut feeling is more likely to be tested in examination. So you will have a domestic company receiving a dividend will be allowed as deduction. However, it will be allowed as deduction only if it is also paying. The deduction cannot exceed the amount distributed. Restriction on double deduction, if it has already been claimed, you cannot claim in the subsequent year. Moving on further, section 115 BBDA. What is 115 BBDA? Earlier, if a domestic company paid to a resident, let's say 30 lakhs dividend, a resident has received from various domestic companies, let's say Mr. A has received 30 lakhs as dividend, till 10 lakhs, Nothing. The moment it crosses 10 lakhs, that is on 20 lakhs, 10% tax was levied. 10 lakhs was exempt under section 1034. On the balance 20 lakhs, 10% tax was there. Now entire 30 lakhs will be taxable. Where is the question of 115 BBDA? Therefore, dividend in excess of 10 lakhs chargeable at 10%, that is withdrawn. Another amendment relating to dividends. Under section 115 BBDA, dividends were taxable at the rate of 10% if it exceeds 10 lakhs. If it exceeded 10 lakhs, that is now withdrawn. Now, when business trust is like a pass-through entity. So whatever is the earnings of the business trust, it will give to its unit holders. When business trust pays, business trust can pay like interest or can pay dividends, all those things can pay. When the business trust pays interest, TDS would be applicable under section 194 LBA. When the business trust pays dividends, earlier dividends were exempt. Therefore, 194 LBA was not applicable. Today, dividend is not exempt because the company is not paying dividend distribution tax. Therefore, TDS would be applicable under section 194 LBA if business trust distributes dividends to unit holders. Once the business trust distributes interest, 194 LBA was applicable. Now 194 LBA got amended and it includes dividend also. Similarly, one more that we discussed, 195. If dividend is paid to a non-resident shareholder, then under section 195, tax has to be deducted by the domestic company. So these are the various amendments that we have got for dividends. Quickly summarizing the entire thing for the sake of clarity, just in a minute of discussion that if at all we have to. So we started stating that dividend distribution tax abolished. Because dividend tax got abolished, dividends are all taxable in the hands of the shareholder or the unit holders. Section 57 allowed interest alone Section 57 now allows interest alone to the extent of 20%. So you have got 194 TDS by a domestic company at the rate of 10% or 7.5%, and there are exemptions that you have got for TDS. Similarly, 194K if the mutual funds or UTI pays, again it is 10% or 7.5% depending upon the period for which it distributes. Again, if it is going to be in the nature of capital gains, it will not be applicable. Then ATM, we had a very detailed discussion which talks about deduction for a domestic company. Then two small amendments relating to dividends. Now, moving on to special rate of tax. There are two special rate of tax that got introduced. Two special rate of tax that got introduced. One is section 115 BAC, that is for individual and HUF. The other one is section 115 BAD. We will see after this immediately. Just before this, somewhere in September or October 2019, when the tax amendment laws was brought into by our finance minister, two sections were introduced at that point in time, 115 BAA, BAB, not amendment relating to this examination, amendment relating to earlier examination. These were all applicable for company. On a similar lines, I will not say same, on a similar lines, now individual and HUF has got new tax rate under section 115 BAC. So this is the slab rates that we have got. It's very, very simple to remember. Up to 2.5 lakhs. Every slab increases by 2.5 lakhs. Every slab increases by 2.5 lakhs. Then it's 2.5 to 5, 5 to 7.5, 7.5 to 10, 10 to 12.5, 12.5 to 15 and above 15. Every slab increases by 5%. 0, 5, 10, 15, 20, 25 and 30. So you don't need to even actually mug up. If someone asks, let's say, what is the tax rate for, let's say, 12 lakhs? You don't even know, just apply. 12 lakhs falls into which bracket? It falls here, right? Maybe fifth. So therefore it is 20%. Because we start at 0, it will be 20%. That's all. Every on the left hand side, which is your income, it increases by 2.5 lakhs. On the right hand side, it's your tax rates. It increases by 5%. As a very, very simple thing, remember like this, right? Now, what happens to the tax rate that we have got already in existence, which is 0 to 2.5 lakhs, same, which is 0%, 2.5 to 5 lakhs, 5%, that also remains same. Then 5 to 10 lakhs was 20%, more than 10 lakhs was 30%, that slab, that will continue. What happens, we are going to see. Now one thing that we need to understand is the rates of surcharge and cess remain same. Surcharge is applicable once it exceeds 50 lakhs. 50 lakhs surcharge will be 10%, and you have got 10, 15, 25, 37, all those things that will remain. Cess is 4%, that will continue. So one is the new slabs along with the new rates of tax. Slab increases by 2.5 lakhs, rates of tax increases by 5%. Is it not beneficial? Of course. Why? 10 lakhs of income is now taxable at 15%. Everyone will go to this. No. You need to understand that there are certain conditions that has to be followed. Before we go to the conditions, we have got one more thing. Let's say individual. When I say individual, this is also applicable squarely for HUF. Every time, let's not repeat individual HUF, we will say individual has got business income. Has got business income. He can either choose the new regime or old regime. New regime or old regime. Old regime is the earlier one, new regime is what we are discussing now. Once he chooses, that would be applicable for all the subsequent years. But whenever he wants, he can choose the new regime. Current year I feel I don't want. Okay, no problem. After 2 years I want to choose. No problem. Whenever you want, you can choose. But once you choose, you cannot come back. This is a one-way passage. Let's say individual does not have business income, no business income. Then every year he can choose old regime, new regime. This year I will choose new regime. Okay. Next year I want to go for old regime. No problem. So if you at all you have got business income, if individual HUF has got business income, the option once exercised shall be valid for all the years. But the option means either old or new regime can be exercised every year, if you don't have business income. So option is like this. No business income, you can go every year. Current year you want to choose old regime, no problem. New regime, no problem. Next year I want to go for the change, no problem. But if there is a business income, once you choose the new regime, it will be valid for lifelong. When can you choose new regime? Whenever you want, you can choose. Now, the option shall be invalid if the conditions are not satisfied. What conditions? We are going to discuss those conditions. So, to ensure that you are having this valid option, all the conditions that you are going to discuss should be satisfied. Special rate of tax will remain same. Special rate like 111A, short term capital gain STT paid, 112A, long term capital gain STT paid, 115BB cash flow income, 112 long term. All those special rate of tax will remain same. Even under your old regime that we have, special rate of tax will apply the special rate of tax. Let's say you have got a lottery income, that will be taxable 30%. Even if your lottery income is let's say only 4 lakhs, that will be taxable 30%. My long term capital gain is let's say 40 lakhs, that will still be taxed only at 20%. I have got a short term capital gain of 1.5 crores. It will still be short term capital gain where STT paid. Still it will be taxed only at 15%. 1.5 crores, why 30? No, because of the special rate of tax. If you choose this 115BAC, alternate minimum tax is not applicable. AMT will not be applicable. That means they are exempting you from AMT. So these are the important things that you need to. Remembering this is quite simple according to me, because every income has to be increased by 2.5 lakhs. Every rate has to be increased by 5%. This is where you have to be careful. If you choose once, you have to mandatorily follow for all the years the new regime only. If you have got business income, in case you don't have business income, you can choose whatever you want. Special rate of tax will continue to be. I have given only examples here. Individual HUF. Once you opt for this, 115 JC is not applicable. What are the conditions that you have got? Now these exemptions that you are discussing, these things that you have got will all be not available. These exemptions that you have got will all be not available. I will quickly run through these subjects. I am not going to have a very detailed discussion on this. For the sake of time, we will quickly run through. Leave travel concession, section 10 subsection 5 that you have got. Leave travel concession, 2 trips in 4 calendar years you can claim, that is not available. House rent allowance, everyone would be aware of this 1013A, that will not be available. All special allowances under section 10 subsection 14 will not be available. Exemption for minor, section 1032, which is 1500 per child, that will not be available. If at all you are on unit in SCZ, 10AA will not be available. What are they saying? I will reduce the tax rates. Correspondingly, I will not give you many exemptions. Right? So therefore, you have to choose whether you have to apply this tax rate in a very simple nutshell. Apply this tax rate by taking the exemption. apply the apply the tax rate, this tax rate without choosing the exemption. Without choosing the exemption, apply the old by choosing the exemption, whichever is beneficial you choose. Because if you don't have business income, I can keep shifting. That means take exemption, choose the old rate. See how much tax you get, old rate or old regime. Don't choose the exemption, choose the new regime. See how much tax you get. Accordingly you choose, that's all. That is what the advice would be. Right, standard deduction for salary, you get 50,000 rupees, no deduction. Entertainment allowance, which is under section 16, I am not going to have a detailed discussion on this. Professional tax, whatever professional tax that is paid will all be allowed as deduction usually, but if you choose a new regime it will not be. Interest on self-occupied property, under section 24 you can claim 2 lakhs, that cannot be claimed, Loss from house property cannot be set off against any other head. Usually loss from house property can be set off against any head of income. It can be set off against any head of income. There are no restrictions. Of course, you can set off only 2 lakhs. Maximum you can set off 2 lakhs. But if you choose this, you cannot claim. You cannot claim anything. You cannot claim any loss. Additional depreciation for business income. If at all you are a manufacturer, you will be eligible for additional depreciation. Right, on plant and machinery you will be eligible. That additional depreciation, normal depreciation is you are eligible. Additional depreciation not eligible. Then continuing, section 33AB and 33ABA, that is for tea, coffee, rubber, all those things. Tea, coffee, rubber, site restoration, all those things you cannot claim. Deduction for scientific research under section 35. Deduction for scientific research you cannot claim. Capital expenditure for specified business 35AD. 35AD gives you like 13-14 business, cold storage, warehouse for sugar, warehouse for agricultural products, fertilizers, like this. It gives you various kind of business. The moment you incur any capital expenditure for that business, fully allowed as deduction. But 35AD itself is not allowed. Deduction for family pension. Section 57 gives you 1/3 or 15,000, whichever is lower. You cannot claim that. Chapter 6 deduction itself is not possible. Chapter 6 deduction itself is ATC, ATD, all those things not possible, except two. National Pension Scheme, ATCCD, that is also only employer contribution to National Pension Scheme. ATCCD can be claimed, ATJJA can be claimed. That is 30% of wages paid to additional workers. Like this, we have got a deduction. Those things can be claimed. That means only 2 Chapter 6 deductions can be claimed. Other Chapter 6 deductions cannot be claimed. ATC, ATD, ATDD, nothing can be claimed. Only 2. One is ATCCD, which is also only employer contribution to National Pension Scheme, and ATJJA can be claimed. Food and beverages through free food and beverages through meal coupons cannot be claimed. That means most of the exemptions that are available for an individual, they say it's not available. I cannot give you. What are the exemptions that are available? Most, I will not say everything, it is not available. Take the new regime with a lower rate of tax. That's why even for an income of, let's say 10 lakh rupees, it's only 15% tax. Earlier, if at all it crosses 10 lakhs, it is 30. Here you are still only in 15% of tax. Let's say my income is 11 lakhs, you will pay only 20%, unlike the old regime where you will be paying 30%. So you have to be little bit careful here by not claiming the exemption. So moral of the story, as we keep discussing, claim the exemption, go for the old rate, see how much tax you get. Let's say you get 5 lakhs of tax here. Do not claim exemption, see what is the new regime. You have got 6 lakhs of taxes, prefer only old regime. Apply this every year if you don't have business income. Right, this is the exemption that you have got, conditions. Then 2 more special conditions that you have got. Yeah, if at all you are on unit in IFSC, 80 LA also allowed. That means we saw 2 things, Chapter 6A, ATCCD and ATJJA can be claimed. If at all you are an unit in IFSC, 80 LA also can be claimed. 80 LA also can be claimed. Now let's say I chose this new option in the year 21-22. I chose this new option in the year 21-22, and I got a business loss. To the extent of, let's say, 10 lakhs. Business loss can be set off. There is no restriction. House property loss alone cannot be set off. I got a business loss of 10 lakhs. In this business loss of 10 lakhs, there are certain deductions are available. Let's say scientific research deduction is there inside this 10 lakhs. That cannot be carried forward. That means out of the 10 lakhs, 2 lakh is scientific research loss. You cannot carry forward. 2 lakh is scientific research loss, cannot be carried forward. This 2 lakh is, let's say, scientific research loss, cannot be. Why? Let's read this. While computing the total income, set off of any loss carried forward or depreciation from earlier year is on account of any of the above deduction. The loss is on account of these deduction. The loss is on account of the current year. These deductions are not allowed. Earlier I was following only old regime. Therefore deductions was, you would have claimed those deductions. Because of those deductions I got a loss. That loss cannot be carried forward. That would not be allowed. To the extent of the deductions that you have got, to the extent of these deductions, whatever that we discussed in 3, big thing that we discussed, you cannot have a loss on account of all these things. Additional depreciation you can have a loss, or you can have a loss from interest on house property. All these things you could have a loss. If there is a loss on account of these items, those loss cannot be carried forward. Those loss cannot be carried forward. In a very simple nutshell, current year these deductions are not allowed. Last year these deductions were allowed. Because of the deductions in the last year, I got some losses. That loss cannot be carried forward. That loss cannot be carried forward. Then, one important thing is, let's say I got a depreciation, unabsorbed depreciation, which is, let's say, 5 lakhs. This unabsorbed depreciation, to the extent of 5 lakhs, let's say this includes 1.5 lakhs on account of additional depreciation. Current year additional depreciation not allowed. This 1.5 lakhs also cannot be claimed. Future, I cannot set off these losses. I cannot set off the losses. That is, if there is a loss on account of these deductions, once you come to the new regime, those losses cannot be carried forward. Then, maximum depreciation that can be claimed is only 40%. In any year, depreciation under section 32 in respect of any block of asset, if it is more than 40%, it would be restricted to 40%. Only one place where you can have 40%, more than 40% is the motor car purchased between August 2019 to 31st March 2020. That is, in the earlier year there was an amendment. Only in that case it is possible. Today every rate of tax is less than 40%. Therefore, this becomes more of theoretical. Practically you will not have, but still, let's say if there is a block which is eligible for, let's say, 50% depreciation, just hypothetically, it will come down to 40%. Right. This is the thing that we have got for individual or HUF. This is the thing that we have got for individual or HUF. Similarly, for a cooperative society, 115 BAD they have brought into, whereby they said the new thing, it's 22% flat rate of tax. For a cooperative society, 22% plus 10% cess, or 10% surcharge and 4% cess. In all, the effective rate of tax would be 25.168%. Now, for an individual or HUF, the new regime is slab rates. Old regime was also slab rates, new regime is also slab rates. For a cooperative society, old regime is slab rates. Once it exceeds 20,000 rupees, it will be 30% tax. Very small slab that you have got. But here, let's say I am a cooperative society having an income of, let's say, 50 lakh rupees. Under the old regime, I will be 30%. New regime, it will be only 22%. However, the following deductions again cannot be claimed. These deductions not possible. You cannot claim these deductions. Almost the same thing that we have got here. Earlier, if at all we go back to the section 115 BAC, we were saying deductions for leave travel concession, house rent, special exemption. These and all cannot be applied for cooperative society. These are all specific for individual. Therefore, whatever is applicable for cooperative society alone has to be brought in. That's all. That is the only change that we need to consider. So, section 10AA for cooperative societies in SCZ they cannot claim. Additional depreciation not possible. Then deduction under section 33AB, 33ABA. Deduction under section 35(1), 35(2). All are for scientific research. Earlier also we saw this scientific research we saw same manner. Scientific research expenditure cannot be claimed. Deduction under donation or expenditure on scientific research. Here also you cannot claim. All those things what are we discussed, same thing. I am not going to have again very detailed discussion. Specific for statistical research, national laboratory 35(2) AA. All these things cannot be claimed. Again 35 AD, capital expenditure on specified business, that 13 or 14 specified business, cold storage, those specified business cannot be claimed. 35 CCC, agricultural product, expenditure for notified agricultural project cannot be claimed. Same manner, chapter 6 deductions cannot be claimed. There we saw two. One was 80 CCD can be claimed, 80 JJAA can be claimed in the earlier regime, and that is for 115 BAC, individual HUF. 80 CCD can be claimed only by an individual, it cannot be claimed by a cooperative society. Pension scheme, why cooperative society is involved? So 80 CCD automatically is not applicable for cooperative society, therefore they can claim only 80 JJAA. So chapter 6 deductions cannot be claimed other than 80 JJAA. Chapter 6 deductions cannot be claimed other than 80 JJAA. Same manner again, it says certain losses not allowed to be set off. If it is on account of any of the deductions attributable, it will not be allowed. Maximum can be only 40%. These two already we had in 115 BAC. Whatever we had, same thing, just there is no change at all. It just repeats. No difference at all. Absolutely there is no difference. Now, these are the two special rate of tax that got introduced. One is 115 BAC, the other one is 115 BAD. In the assessment of cooperative society, there is a separate chapter, friends. Please ensure that you are thorough on this assessment of cooperative society, because 115 BAD is an amendment. My gut feeling is again possibility that it could be tested. Now, moving on to the other amendments that we have got. Again, one important thing that you need to, 115 BAC, we said if an individual or HUF, they have got a business income, they can choose the option, but once they exercise the option, that is final. If they don't have business income, every year they have got the option. Here, you have to choose an option. Once such option is exercised, it would apply to all subsequent years, and you cannot withdraw. The concession would be applicable. You have to choose. It's like individual having a business income. Once you exercise this option, you cannot come out. You cannot come out of this option. Similarly, again, 115 BAD, if you choose, AMT is not applicable. Like the moment you choose, in a very, very simple nutshell I have to say, you choose 115 BAA, this is for company, or 115 BAB, again for company. MAT not applicable. For a company, what is not applicable? MAT. Not applicable. Likewise, 115 BAC or 115 BAD, if you choose, AMT not applicable. That is, these new rate of tax, if you choose, this is the only rate of tax. Minimum alternate tax or alternate minimum tax, both are not applicable. In a very, very simple nutshell. Earlier also, even under 115 BAA and BAB, MAT was not applicable. Here also, AMT will not be applicable. Now, moving on to section 50C. Section 50C, which is full value of consideration for immovable property. What is 50C saying? 50C says, let's say, I got a stamp value of 150 lakhs. My sale consideration, let's say it is 100 lakhs. Usually what will be my full value of consideration? My full value of consideration would be only 100 lakhs. Usually, generally it will be my selling price, generally. But in case of an immovable property, the full value of consideration would be, FVC here would mean full value of consideration. Full value of consideration would be stamp value or selling price, whichever is higher. Stamp value or selling price, whichever is higher. So full value of consideration would be value adopted by stamp valuation authority or actual consideration, whichever is higher. Let me slightly change this. Let's say my stamp value, is 105 lakhs. 105 lakhs. My selling price remains at 100 lakhs. My selling price remains at 100 lakhs. What we will do? Stamp value or selling price, whichever is higher. Like this we will do. 105 lakhs or 100 lakhs, whichever is higher. So I will do for 105 lakhs. No. Said where the stamp value does not exceed 110%, the consideration would be the full value. What is the stamp value? Stamp value is only 105%. Stamp value is only 105%. So you will take only selling price. You will take only selling price. I will just summarize this. Summary is like this. You will compare selling price with the 110% of stamp value. You will compare selling price with 110% of, you will take selling price with stamp value, which will be 110%. If it exceeds 110%, which exceeds, stamp value exceeds 110%, then stamp value would be the full value of consideration. If it is less than 110%, then selling price would be the full value of consideration. Selling price would be the full value of consideration. So, if I will put it like this, if stamp value is more than 110% of selling price, then stamp value would be consideration. If stamp value is less than or equal to 110% of selling price, then selling price would be consideration. You cannot take exactly selling price and stamp value. They are giving the buffer of 10%. This is not new, friends. Earlier it was 105%. Now the amendment is 110%. That's all. There is no change in this provision. This provision is same. The comparison is same. But instead of 105%, they are given extra leverage of 5%. Extra. Now they are given extra 5%. It's now 110%. Earlier we said till last year it was stamp value with 105%. Here it is now 110%. This comparison remains same, except there is a change in the numbers. Now similar amendments has been brought into in 56, 210 and 43 CA. 43 CA and 50 CA are one and the same. While 43 CA is applicable if at all you are a real estate person. I buy and sell land. I am a real estate person. 43 CA is applicable. You are an investor in land. 50 CA is applicable. That means at the time of sale of land and building, if you are liable for capital gains, 50 CA is applicable. If you are liable for business income, 43 CA is applicable. 56, 210 is gift. 56, 210 is gift. Again, I am not going to have a very detailed discussion here. Compare selling price with 110% of, compare stamp value with 110% of selling price. If stamp value is more, take that. If stamp value is not more, take the selling price. But it has to be compared with 110%. The next amendment that you have got is section 44AB, which is for tax audit. Now, if the business income exceeds 2 crores, you will be liable. Professional income exceeds 50 lakhs, it will be liable. This is the usual thing that we will have. One additional thing that they have brought is, in case of a person carrying on business, applicable for only business, please understand, friends. They would be liable only if the turnover exceeds 5 crores. For a business, turnover exceeds 5 crores, they would be liable if two conditions are satisfied. Two conditions. First condition, cash receipts is less than 5% of total receipts. That means they are saying move from cash to bank. Don't go for cash. Get everything from bank or account pay check or NEFT, RTGS, something like this. Same manner, aggregate cash payment is less than 5% of total payments. So cash payment during the year should be less than 5% of the total payments. That means you can make by account pay check, demand draft, you can pay by NEFT, RTGS, any of those things. Similarly, cash receipt should be less than 5%. Then turnover criteria is 5 crores. Now let's say, to quickly summarize this, for a business, you have got 5 crores, 2 crores. If two conditions are satisfied, then it will be turnover limit is 5 crores. If even one is not satisfied, That is total payment, that is cash payment exceeds 5% or cash receipt exceeds 5% or one does not satisfy, then the turnover limit will be 2 crores. If both are satisfied, it will be 5 crores. If even one is not satisfied, it will be 2 crores. Now, usually audit report has to be filed. Audit report na, that form 3CA or form 3CB has to be filed along with 3CD. You would have all seen in your articleship. That has to be filed along with the return of income. But here it says it has to be filed 1 month before filing the return of income. It has to be filed 1 month before filing the return of income. So there is an amendment in 139(1). We will discuss a little bit later. So 1 month before filing the return of income, it has to be. Usually what we will do, return of income and tax audit report will be filed together. But tax audit report has to be filed 1 month before the return of income. This is section 44AB. Then equalization levy forms part of your international taxation. Please understand, it is not there in your Income Tax Act. It is not there in your Income Tax Act. This is in a separate act altogether. So section 165A has been introduced. Equalization levy would be at the rate of 2%. Equalization levy, I am not going to have a basic discussion on equalization levy because we have got very few time left with. So we will only see what is the amendment that you have got. Equalization levy will be at the rate of 2% on the amount received by e-commerce operator. Of course, it is a non-resident e-commerce operator because equalization levy will more likely be a non-e-commerce operator from e-commerce supply made by it under 3 scenarios. A non-resident e-commerce operator receives from a resident in India. A non-resident e-commerce operator receives from a resident in India or receives from a non-resident in specified circumstances. From a resident in India, all circumstances. From a non-resident only in specified circumstances. What is that specified circumstances? We are going to see. In a couple of slides later, we are going to see. Third, here it's from any person. From any person. E-commerce operator, how do you do? You need internet. Now, if that internet protocol IP address is in India, so a non-resident purchases using an IP address in India, applicable. A resident purchases using an IP address in India, applicable. So, it is from a non-resident e-commerce operator, receives from a resident, or receives from a non-resident under specified circumstances, or receives from any person who buys either goods or services. Today we have got e-commerce for both. Amazon, typical example for goods. Then you have got various kind of services. Uber, typical example of services. E-commerce operator, typical example of services. So you have got to a person who buys goods or services or both using an IP address in India. Now, non-applicability. That means this equalization levy is not applicable. If the equalization levy is already covered in section 165. 165 is already in existence, which is at the rate of 6% for online advertisement. Like this we have got. If this transaction is solid, it's not all e-commerce operators are covered under section 165. There are few things that are covered. If it is already covered, it will not be. Second, if the income is less than 2 crores. If the e-commerce operator from supply of goods or services, if it is less than 2 crores, not applicable. Third, e-commerce operator has got a permanent establishment in India, and the income is directly relating to permanent establishment. I will just take a minute to explain to you this non-applicability. Why is this equalization levy? Equalization levy is applicable because there are people who earn money using some kind of resources in India, but they don't pay taxes. Why they don't pay taxes? Because they are located outside India. Of some kind of reasons they don't pay taxes. Therefore, equalization levy has been brought into. So it is applicable only if you are a non-resident, because anyway resident you will be paying. If the non-resident has got a PE, then anyway they will be paying taxes. If at all you have got a PE, anyway you are paying taxes. Because you are paying taxes, equalization levy will not be applicable. So e-commerce operator has got a permanent establishment in India, and it is related to that permanent establishment. That is, this e-commerce operation is relating to the permanent establishment. Let's say, just a hypothetical example, Amazon has got a branch office in India, and the e-commerce operations is by way of this branch office, then equalization levy is not applicable. The very simple nutshell is, it is only to bring all those things within the ambit of equalization levy, all those income within the ambit of equalization levy. Right. So, if the e-commerce operator has got a permanent establishment, equalization levy is already covered under section 165 and the total is less than 2 crores, equalization levy is not applicable. Now, let's say e-commerce operator is situated in USA and he wants to claim treaty benefits and say, I will not pay equalization levy. No. Treaty benefit is applicable only if it is taxable by way of Income Tax Act. This is not taxable by way of Income Tax Act. Therefore, for claiming or for going for equalization levy, treaty benefit cannot be claimed. Like we discussed, no. Income Tax Act or DTAA, whichever is beneficial. Like this you cannot do. Equalization levy is mandatory to be paid by the e-commerce operator. Now, specified circumstances. Why? The non-resident e-commerce operator earns by way of earns from a non-resident under specified circumstances. See, if at all we have to go back, it would be chargeable rate of 2% on the amount received by e-commerce operator from way of e-commerce operator to a person resident in India. If it is resident to India, all circumstances. If it is non-resident India, only under specified circumstances. What are those two specified circumstances? First, let's say Amazon USA earns income from a non-resident. Why should it pay tax in India? Ideally, it should not pay tax. Let's say Amazon USA earns income by supplying to a resident of USA, that is non-resident of India. Why should it pay tax in India? Not possible. You cannot ask that person to pay tax in India. So they said non-resident only under specified circumstances. What are those specified circumstances? This non-resident is earning the income by way of sale of advertisement targeted to a person resident in India or through internet protocol located in India Similarly, sale of data collected from a resident in India or using internet protocol located in India. That means again there should be some kind of Indian relationship. Otherwise, equalization levy is not applicable. A non-resident e-commerce operator giving to a non-resident, usually not applicable unless there is an Indian connection. In a very, very simple nutshell, unless there is an Indian connection, it will not be applicable. Now, equalization levy, what happens? There are two sections that you have got. One is 165, which is already in existence, which is on account of online advertisements, all those things, which we are not going to have a discussion because it is already in existence. Now this is section 165A, new thing that has been brought into, not Income Tax Act, Finance Act 2016. It is by of Finance Act 2016. 165A of Finance Act 2016. It remains outside the Income Tax Act. But once equalization levy is paid, section 10 subsection 50 says that income is not taxable under Income Tax Act. You have paid equalization levy, you cannot again tax under Income Tax Act. So on any kind of transaction where you have not paid equalization levy, it would be applicable. If at all you have paid equalization levy, 1050 it exempts. Now, what is the due date? Under section 165, it is 7th of succeeding month. It is all 7th of succeeding month. Here it is quarter wise. That is 165 is like TDS. 165 is like TDS. It is 7th of the succeeding month. But here it's all quarter. So see, due date of quarter ending 30th June, it is 7th of July. Date of quarter ending 30th June, it is 7th of July. Quarter ending 30th September would be 7th of October. Quarter ending 31st of March would be 7th of January. Simple friends. 7th of the next quarter. That's all. 7th of the next quarter. You have got April to June. 7th July. April to June would be 7th July. Then next would be July to September, would be 7th of October. Then the third would be October to December, would be 7th of January. And the last one is 31st of March. That has to be paid on 31st of March itself. That has to be paid on 31st of March itself. This is the due dates that we have got under section 165A for the purpose of payments under section 165A. For 165, it is 7th of the succeeding month, which we are not having a very detailed discussion. Here it is quarter-wise payment that has to be made. Now, this 1050 that we are discussing, we need to understand, once equalization levy has been paid, whether under section 165 or 165A, whether under section 165 or 165A, it is all exempt under section 1050. Once equalization levy is paid, you will not be liable for Income Tax Act. Why? Concept of equalization is only like this. Non-resident earns income in India by way of some sources in income in India, and they are not paying taxes. Therefore, they brought in equalization levy. Once equalization levy is brought, you cannot again ask them to pay Income Tax Act. Therefore, one more section got introduced in this Finance Act, which is section 10 subsection 50. It says, once an income is liable for equalization levy, it will not be liable for Income Tax Act. It will not be liable for Income Tax Act. Now, these are the amendments that we have got. There are much more amendments that are there in your income tax that is brought into and applicable for November 21. We will see this in one more session that we have got. Thank you.